All right. Another week. Tonight we're pretty much just going to talk about mutual funds. Some people have been asking some questions about the homework and stuff. Um, it kind of changes up towards the end of the term is kind of the way I do it because people were, working on the midterm and then obviously trying to put some time into your final project. But also it just doesn't lend itself to as many types of assignments. But there's a pretty good assignment for tonight's work, and it kind of explains a little bit about what we're talking about in terms of some of the different aspects of mutual funds, in terms of different strategies that I'll explain a little bit more as we go. Anyway, it would have been a little too much for last week because we hadn't really covered mutual funds and some of the market things that we'll talk about tonight. So, mutual funds. So, mutual funds are not, that much different. They're probably something that I would venture to say every one of you will have some form of mutual fund throughout the course of your life. And mutual funds are based on the stock market. And I know right now it's kind of a scary time if you're looking at investments and everything else, inflation, the rest of it. This is a dip. So you can see there's some other dips. I mean, will it be as bad as the stock market crash, way back nearly a century ago? Will it be a 2007, 2008 kind of thing? Probably already getting there. Anyway, but there's other blips and things. But if you're somebody who, first, let's say the market's screaming along, and just like it had been here, went up to about, 15 or so. And you're like, greed's a horrible thing. You're in the market. You're not going to get out. And then it starts to, let's say in this case, starts to go down. And you're like, oh, this doesn't look good. Yeah, this is really bad. This is not going well. And then finally, down here at the bottom, you panic and you say, I'm losing it all. I'm going to get out. Well, this whole V-shaped recovery is pretty typical. Things go in cycles. And so at this point, I don't know that we're at the bottom of the V yet, but if you were to get out, obviously I don't offer investment advice, but I would not be jumping out here at the, well, actually it did surge a little bit, but that's kind of artificial. I don't see any room for real optimism right now. But anyway, your alternatives, real estate, gold, all these things that are supposed to be hedges, they're all kind of doing the same thing. Nothing is a great investment right now. If it were a great investment, everybody would be zooming towards it. So in terms of all investments, I hate to say it, but the stock market and for tonight's discussion, mutual funds that are based on the stock market are, not horribly bad. Historically, about 10% per year, but trying to guess, that's an accumulative thing looking back over time. And trying to jump in and out, that's a whole nother segment we can talk a little bit about in terms of market timing. The best have tried it, and really people fail miserably at it. Anyway, it's tempting. It's something we all want to do, but trying to guess when the market's going up and getting out at the top and getting in at the bottom, good luck. Many have failed, but everybody tries. So anyway, mutual funds. So they can be, a mutual fund it defies a precise definition because it's all about marketing. They will call these things whatever they want if they think people will buy them. So you'll hear broad classes of mutual funds, but if they can change the verbiage just a little bit to make it sound more enticing, they'll do it. And so, it's all whatever. They don't sell the bacon, they sell the sizzle. They are trying to at least on your end, they're trying to make their funds look the best they can. So some of the names that they'll use and some of the arguments they'll make are, I wouldn't say they're false, but they're sometimes misleading. But anyway, a mutual fund is a collection of typically individual stocks, could be bonds, could be anything. There can be real estate under a mutual fund. But anyway, it's a collection of items, investment vehicles, that are put together in a group, and they can be put together, they can be assembled however that fund manager wants to do it. And his desire is probably to make the most money, but also to entice as many customers. So they're trying to chase the hot thing, where people think things are going to happen. For example, if you want to invest in Vietnam, for example, you would find it very difficult to try and buy individual Vietnamese investments. I mean, the whole currency thing and the tax implications, you'd get clobbered, and you'd spend all your time on non-productive things like trying to assess the tax and the currency fluctuations and things like that. But if you want a mutual fund and invest in primarily in Vietnam, I guarantee you we can find one right now. You can find let's say you're interested in the medical sector and you're not sure exactly which stock's going to go, but you think that sector's going to do real well, or the defense sector. So there's sector funds, there's geographic funds, there's funds that purport to be good for the planet, societally responsible funds, or EV funds, or maybe nitrogen car funds. Anyway, something. Whatever you want, you can find a mutual fund that's probably set up where you can invest in it and do so fairly easily without having to pick that one company. 9 out of 10 startups fail in the high-tech sector, but that one that makes it, man, they do well. So if you had all 10 of them, who cares if none of them go out of business? That Apple or that Google or whoever you had is going to make up for it. So anyway, that mutual fund would be a good investment for that type of thing. But we'll talk more about it as it goes. So they could also be made of bonds. Now, bond mutual funds, not nearly as exciting. But again, if they're private companies, corporations that are offering bonds, and there is an ability for some of these corporations to go out of business and default on the bond, it would be nice again to have that diversification. So this portfolio manager thing, this is kind of controversial. In fact, that's what's going to be part of the homework assignment. We've been in such a great market for so long that people, they perhaps didn't value the portfolio managers, because they're a lot of these fund managers, they're getting paid a pretty good salary. They're buying and selling stuff, and the whole market was going up pretty consistently. And so people who just kind of bought and held and didn't do all these fluctuations, didn't do all this churn and generate expenses, tend to do as well, if not better. And so the homework assignment tonight is going to kind of review this bet that was made between I think it was the head of Vanguard and then Warren Buffett. Warren Buffett, he's a very famous investor. Oracle of Omaha, I've kind of talked about him before. Berkshire Hathaway was his big fund. If you would have gotten Berkshire Hathaway way back in the day, you would be, doing quite well. Anyway, the Vanguard guy, although he buys and sells stuff, that's where he makes money. He's also he's of the opinion that buying and selling, that you can do better than the market, and Buffett was just a buy and hold kind of guy. So they take this position and they make this bet. And it's been a few years back. I guess the example's getting a bit dated now, but just the same, it kind of explains some of the index funds. And an index fund would just be sort of a buy and hold fund. What they would do, they would get an index, like say the Standard & Poor's, the S&P 500, and they would say, this fund is going to be completely boring. We're going to buy, a few hundred shares of each company listed in the S&P 500, and then we're doing nothing. We don't really need a fund manager because we made that initial purchase and we're just going to let it ride. Whereas the other guy is actively managing. He's looking at the stocks, he's looking at the companies, he's this company's having a forecast for having a bad time, so we're going to sell that one. We're buying more of this. We're creating a lot of work, generating a lot of expenses, but we're going to really excel in terms of performance compared to just the buy and hold strategy. And so that's what the bet was about. And you'll kind of listen to a podcast or read the podcast if you want, and then you'll just kind of write a short kind of half page or whatever, a few paragraphs on your understanding of the situation and your thoughts. Motives for investing in mutual funds. So part of it is the ease at which you can invest. Stocks are much more friendly than they used to be. Like I say, I was buying some penny stocks last week, and that would have been not a nightmare, but it would have been pretty darn involved. And you'd have to use a broker, and you'd have to, figure out all the things trading for 9.5 cents per share. And I can't just buy like $1,000 worth. I need to buy, 900 or 9,500 shares or whatever that comes out to be, and all this weirdness. Anymore, I just put down, I want to buy $1,000 worth, and I just do it. And, they've got computers. They can do the math, and they can figure out how many shares I get. There is no broker involved. There is no commission involved. It's dead easy. So that part about mutual funds in comparison, because mutual funds have always been like that. You've always been able just to buy, say $50 a month, and you just set it up on an auto pay thing, and it's just on autopilot. It just goes. Well, stocks are sort of becoming that way if you want to go that route. So the ease of use has kind of gone away a little bit in terms of between stocks and mutual funds, the differences. But the diversification, that part remains. And the expertise of the portfolio manager. Sometimes these guys are good and sometimes they're not. So, but I would say for the most part, they're pretty good. And the other part is, the reason why people would be driven to mutual funds is I want to invest, I want to get, good competitive yields, but I don't want to spend my whole day, analyzing stocks and deciding what to buy or what to sell. And that's a portfolio manager's job. And then to meet specific investment goals. Anytime you buy a stock or a mutual fund, as opposed to even a stock, you can just go and buy whatever stock you want. There may be a couple warnings, but on a mutual fund, you actually have to acknowledge, it's kind of like an end user license agreement, so maybe you read it, maybe you don't. But anyway, they have to provide you with a prospectus. And that's kind of like the, if the portfolio manager is like the coach, this is like the coach's plan. I'm going to buy, stocks like this. I'm going to invest in these countries. I'm not going to take, excessive risk by margining, borrowing money against the account. It sets the rules by which this portfolio manager needs to constrain himself. So again, if you buy this Vietnamese fund and all of a sudden find out you're, deeply invested in Brazil, and the prospectus said your investments are going to be limited to Vietnam, that guy's really, he's broken the law. Securities Exchange Commission would get involved. And anyway, so it kind of sets the rules of the road for what your fund is supposed to be doing, so you have an understanding of what's involved. Net asset value, that's the same as the stock price. It's a little more complicated to compute, especially back in the old days. At the old days, they'd only do it really once per day because there's like a lot of moving parts. Let's say you own a few hundred shares in everything within the Standard & Poor's 500. There'd be some math involved. Not hard math, especially not for a computer, but anyway, mutual funds typically were only quoted once a day, and they weren't meant to be traded that often. The mutual fund companies, they sometimes will have limitations. You can only execute so many transactions per month. They don't like people trading mutual funds like stocks. They get kind of pissy about that, and sometimes they'll prevent your trades. Whereas stocks, the nature of the thing is, yeah, trade as much as you want. And that's really based upon the broker model where they're getting commissions and they encourage it. Now they probably don't care, but it's kind of seamless because that's all automated. It doesn't cost them anything. Open, closed-end funds, not such a big deal. Yeah, we'll look at one of those in Vanguard, one of the companies we'll look at tonight. But for the most part, the real distinction you want with a mutual fund is a no-load fund. People that are, some companies or some representatives will be pushing mutual funds to you, and you'll be approached through some sort of salesman type thing. Well, obviously that salesman, he wants to get paid. He's getting a commission. And in mutual fund terms, they call that a load. So, again, not a great thing for you as an investor. I mean, it's great that the person contacted you and they motivated you to invest. But for you, if you invest through that person, every investment's going to get, a little bit taken out of it to pay that commission. And the sad thing about investing in mutual funds is they'd be taking that money up front, which is, a front-end load, which time value of money, how small amounts of money can generate huge sums of money, 60 years out from now. So if you had that money that the dude took from the commission, you would be quite a bit wealthier. So anyway, no real reason to be involved in loaded funds at this point. There's a tremendous number of no-load funds out there that are available. Anyway, yeah, so I'm not going to spend a lot of time on closed-end. There's some funds that are closed. They can only be sold through certain companies, but by and large, the best funds out there are open, or if they were closed, it's kind of a moot point because you can't get involved in them anymore. If you had something offered to you, it's kind of a scarcity thing where you're getting in on something exclusive, but doesn't happen very often. So this is what I was talking about: load versus no load. Do not charge a fee, stockbroker or somebody. I don't know. I was talking to a friend about stockbrokers because I had an offer to be a stockbroker, and this guy was telling me he had similar experience. And you'd think stockbroker, oh wow, yeah, you need to know everything about stocks. No, you need to have a lot of friends, and they want your friends' names and phone numbers, your family. You're more of a salesman than you are a technician. And, the companies will bring you in figuring that, you can. The worst case scenario is you don't generate much in terms of leads and they just fire you. What they're hoping for is that you get in there and, through your personal and family connections, you open up a new group of customers. When I went for the interview, they were kind of disappointed in me because I didn't really realize the game, and they asked me what I like to do, and at the time I was running marathons and I like to hike, and they were not impressed. They want golfing, they want tennis, they want sports where you're out there with a group of people. That's what they want. It's a very social type thing and generating leads. So they're just going to show you that, yeah, because this guy used a loaded fund, his resulting yield was only 5.6%, whereas with the same performance he would have gotten 10% because it was that commission that kind of bit him. Expense ratio. So this gets back to what I was talking about, where you want to look at the expense ratio. Let's say you get some coach that's doing super well, and whatever. I'm not an Alabama fan, but obviously Nick Saban, famous Alabama coach, he gets paid tremendously well because he wins. And so do the people, the Alabama fans, do they care how much that guy gets paid? Not so much, because they're winning. That's what they want. If I'm getting 20% a year on my mutual fund and the fund manager is getting paid handsomely, well, good on him. He's getting 1% or something out of my 20%. That's fine. But if he's not winning, he's not. He shouldn't be getting paid very much. So this is kind of a tough thing, Needless expenses, though, and a lot of churn and a lot of buying and selling. If they're getting the performance, that's one thing. But if the performance doesn't match the expense ratio, that's when you need to bail. Anyway, funds with lower expense ratios tend to outperform other funds. That's kind of in reference to the market I was talking about. When the market's doing really well, everybody does well. Now that we're in a more challenging market, and I'm not sure what kind of market we're in yet because the dust hasn't settled, but this may kind of go away. It may take somebody who's pretty crafty to figure it out and figure out what to be in, because all the paradigms have been broken over the past year or two. So different types of mutual funds. So again, broad categories. In this one, these are pretty aggressive type funds, and they will say aggressive growth, or they'll label them however they want. It's all marketing, but growth implies that a company is not going to be paying a dividend. This is a company that's probably younger, or at least very aggressive, and is using the profits to grow, to get bigger. And you're going to make money from buying the shares at $10 and them going to $30. If their share price is steady at say $10, they're not paying a dividend. They're not much of a growth fund. So anyway, a growth fund, you're going to make your money through basically the capital appreciation of the price. So that's why these two are related: capital appreciation or a growth fund. But you'll see companies, and these ones kind of defy valuation. I talked a little bit about Twitter, but Amazon there for a while. People, they were not profitable there for quite a while, and people were, well, that's not a good company. But certain people could see the potential, and those who did were rewarded handsomely. And so they didn't get dividends, and they probably still don't. But now, the share price is up quite high. Small caps, mid caps, and there's obviously a large cap as well. But this has to do with the size of the company. And there is a number. It's not important, not testable, but it equates to, so many billions in assets. So, but a smaller company, which typically, if you're more aggressive, probably, that's how big companies get. Once companies get to be a large cap, that's kind of a blue chip or a kind of a behemoth, and it's kind of the elephant in the room. It doesn't move around real fast, and you wouldn't expect a lot of capital appreciation coming on with that one. Now, the reason why they have this listed small cap, mid cap, and they kind of infer that this is a large cap is because that could likely be the case. An equity income fund, anytime you see income means that it's paying a dividend. And so once a company's got to be a certain size, they're not growing so much anymore. They don't necessarily need to be building, sprawling new factories, just, this rapacious growth. No, they're mature companies, and hopefully they're profitable. And so those profits, rather than roll it into new facilities and stuff, they'll return it to the shareholders through a dividend and make their stock more attractive to you as an investor by the fact that it pays a dividend. So if you want to look at this in broad categories, in terms of, segments of your life, these ones would be more aggressive, and these ones would be typically more associated with younger investors or investors that are kind of mid-career. Income funds, there might be good strategies to have them in any phase of your life, but certainly as you get closer to retirement, there's lots of people who would advise you to have some of these more stable, larger companies that are paying an income that you might actually, be living off at that point. Because you're not selling the stock, you're just getting the dividend. And if you do sell the stock, if the stock's gone up in price, you would get a little bit of money from that. But primarily on an income stock, your income would be, your money would be derived from that income through the dividends. And now balanced growth income, so you can combine these things however they want. Sector funds, I kind of hit on that a little bit. Specific industry, so like biotech, defense, whatever you want. High tech, whatever tech. I mean, you can find, I'll show you, there's just so many funds out there. Index funds, so that's where I was talking about, where it's very boring. Buy and hold, really don't need a fund manager. You need him for a day. He buys the stuff and then it's hands off from there on out. International stock funds, there are two different types. There are actually two different things. There's an international fund and then there's a global fund. So again, if you read the prospectus of an international fund, the prospectus is going to have to say that we will be investing in companies outside of the United States, right? Because it's international. If it says global, they could be investing anywhere, to include the United States, since most of these companies are based in the U.S. So anyway, this is making the assumption these companies are based in the U.S., which most, you can buy, again, mutual funds through a foreign company, but again, it's going to generate all sorts of tax, currency implications, other things. We take it for granted that we've got a fairly stable currency, but there's places. I lived in Turkey for 3 to 5 years, I guess. 3. Anyway, the currency there was just, it changed so much. There were ways to make money and still invest there, but if you tried to do it remotely, from the United States, you'd get clobbered. That's a full-time job. Investing in Turkey has as much to do with the currency fluctuations as it does have to do with the companies. And then socially responsible, find companies that whatever your thing is, whether it be carbon or no oil or no defense or no whatever, you can find a mutual fund out there if there's a market for it. I would, want to look at the performance, just to make sure that they at least have some business focus. But and it could be argued that maybe they've got the best business focus, that the other industries are dying. But I don't know that the data would prove it out. But you'd have to check it out. Other types, so yeah, small cap growth. I mean, it's however they want to label it. Exchange traded funds. What's happened here is, again, due to the automation and due to some of the brokers or exchanges want to kind of get in on the action, they'll say, we can offer our own mutual funds. In fact, we'll offer them on the exchange, and you can trade them just like you trade stocks. And there you go. There's a product for you, an ETF, an exchange traded fund. Vanguard, we'll look at that in a second. Vanguard's just nothing special, just another company, been around forever. We'll look at maybe T. Rowe Price night. We looked at Fidelity. What I'm saying is that most of these companies, they all seem to be based in Boston, or at least on the East Coast. And I don't know. They're not. They're not all that unalike. They all seem to be fairly reputable. I've done business with a number of them, and it kind of depends on who you're working with. I got associated with Fidelity because that's who UAA was using, and but they also have there's an educational one. I can't remember the name of it right now, but it's one that caters to teachers and professors and nonprofits. There's so many companies out there, but we'll look at a couple of them, and I don't think you're going to go wrong. Most of the time, it has to do with the simplicity thing. You can get different companies' mutual funds through different brokerages, so that in essence they have almost the same products. And just for ease of taxes at the end of the year and ease of emails and junk mail and everything else, it may be best to be associated with a single company rather than have 5 different ones going. Bond funds. So some of these can be government bonds. They could be mortgage bonds, and then the corporate bonds. So I think we're pretty clear on that. Mutual funds that focus on high quality firms that tend to, again, that's a generalization. One of the reasons, if you see people making money in, whatever they want to call them, high risk bonds or junk bonds or something like that, to buy an individual junk bond might be kind of suicidal. But to buy a fund that has a whole range of junk bonds, you might gain some diversity. That strategy did not work so well back in the mortgage crisis, because what they did, they said, well, yeah, these aren't great mortgage bonds, but these collateralized debt obligations. But when we put them together in a big pile, they're somehow better. So anyway, but what I'm saying is, just because something's in a corporate bond fund does not mean that it's going to be super high quality. You have to look at the underlying assets. And you can do that with a mutual fund as well. Also, sometimes where you think, oh, I've got a couple different mutual funds, so I've got some diversity. Well, yeah, I kind of thought that as well until I looked at some of the different funds I had, and I realized they were primarily, Apple and Google and Alphabet now. Anyway, it's all fine, but yeah, no, I had a false sense of diversity because the underlying stocks were all the same. So, okay, let me see how they did this. Maybe I read that wrong. Corporate bond funds, they're saying high quality, and then high yield bonds. Anyway, it's the distinction. You have to look at the underlying assets. Munis. A lot of times people want munis because they're can be tax free, but as I explained last time, you have to look at the at your individual tax bracket to figure out whether it's a good deal for you or not. Bond indexes, international bonds, so same thing goes with global. So outside of the U.S. as well as the U.S. Maturity classification, since they're bonds, they're going to expire at a certain point, so you can segment them that way. Return from mutual fund. So dividends, capital gains, and then capital gains from redeemed shares. So there may be, depending on the mutual fund you have, it may contain some large companies that are paying dividends, some income stocks. There may also be some transactions that take place by the fund manager that may generate some money, and since you in essence own those stocks that were sold under there, you made a little money there. And then at the end of the day, or not end of the day, but whenever you decide you're going to get out of that mutual fund, the net asset value, if the share price for that mutual fund has changed, you would make some money there as well. These could all be losses as well, keep in mind. So, yep, anything you make money on, there's going to be a potential. And some of those short-term gains, you may have some exposure there if they're selling them underneath. You notice on the mutual fund, the index one, since they didn't do any trades, they obviously kept everything for longer than 1 year. So risks are the same as a stock. Limited risk, limited return. Yep. You pay your money, you take your chances. If you take no risk, you make no money. And it gets eaten away by inflation. So it's not, there's, especially in a market like this, there's no happy place to be. Moderate, high risk, high return. It all depends on your perspective. The same things that apply to bonds, apply to the bond mutual funds. So, trade-off between expected risk and return. I hate to disagree with these guys all the time, but it depends on the index. There are technology indices, indexes, whatever. It depends on the size of the company. If it's the Dow Jones, if it's the entire market, maybe it is going to be fairly stable. But if it's a index, the Russell Growth or something like that, that's got a lot of high-tech stuff in it, could be more volatile. Income funds, that's due generally to the companies just being kind of the big dominant companies in that industry. And then when we start getting into, some of the more aggressive funds and down in technology, yeah, the risk and return do go up higher. And then when you get to a foreign stock, you have the currency, and also you have maybe a new emerging market that's going to make it a little bit more problematic, especially in this case, one small country. So, again, a lot of generalizations in there, but that's the way it looks. So, for mutual bond funds, so short term in bonds typically means lower risk because you're not exposed to the longer term implications of interest rate changes. Now the quality of the underlying assets, so this is the government, essentially no risk. Here's all mortgages, not a whole lot of risk compared to corporate stuff. Depends on the companies, but generally big corporations. And now we're into high yield companies that may default, so they're going to have to pay a lot. So, yep, longer term, more sensitive. Must consider the company going out of business or just basically defaulting. All kinds of risks. I think we talked about this. So what you're trying to make sure is that, number one, you've got something that's compatible with your risk tolerance. And to have zero risk tolerance is, you're not, you're exposing yourself to risk by not taking any risk. Accepting the current inflation rates is probably not the best thing to do. To maybe park it somewhere for a little while till the markets kind of sort themselves out, that might be an effective strategy. But for the long term, you kind of got to get off the porch, or else you're never going to generate any wealth, and your buying power is going to be decimated. That keeping it in your mattress or wherever is probably not going to work for you. And so shorter term, and then we get in the long term. You're rolling the dice that this high yield thing that company is going to continue to go forever on a single country. So anyway, it's pretty easy to figure out how they came up with their their choices. Either extreme is probably not great. But I have had short-term corporate bonds, and like I say, I was getting. It was similar times to this. It was several years ago, early '90s, but inflation was higher, and I was getting 8.5%, and it was nice. No defaults, no nothing, and it was just a. I think it was Janus was the name of the company. I'm not sure if they exist, but they're based out of Kansas City. I think they became no, it was American Century. Anyway, another company. They're all kind of interchangeable. Determine your investment objectives, evaluate your risk tolerance, decide on the fund characteristics, and review the prospectus. So, a lot of this can be done by looking at some of the online resources. What you have to be careful with mutual funds or any stock perspective, but especially mutual funds, you pick up something like used to be Money Magazine, and I'm sure they still have an online version, but they'd have the 25 best performing mutual funds, and so you dump a ton of money into number one, their top pick. Well, it was based on historical performance, and maybe something led to them having an exceptional year the year before. But anyway, you're buying right at the tippy top, and maybe there's been a change of hands. Maybe in terms of the portfolio manager, maybe the market conditions have changed. Maybe the fund just had a phenomenal last year and isn't going to be able to top it. So that's what makes it tough. You got to figure out whether that is going to continue. So you'll always see this disclaimer about past performance does not indicate, future earnings or something to that effect. And that's what makes it more difficult. Talked about the prospectus. Yep. Past performance. Yep. And it's quite easy to find all that data, but the forward-looking information is what's super valuable. Fees and expenses, again, if they're earning their money, if they're doing great, I don't mind paying an exorbitant amount to that manager who's getting the performance. But if they're not getting the performance, no way. The distribution, capital gains, you'll have different options when you're buying a mutual fund. And because these amounts are kind of, fairly minor, fractions of a cent sometimes, or maybe a few dollars, or if you get more money. Anyway, you typically just tick the box saying that to reinvest dividends and capital gains so that your fund grows and you don't have these small checks and distributions issued to you. Minimum investment and balance, super easy. They'll usually have some, minimum investment of $2,500 or something like that, but they'll waive it if you sign up, to take a minimum of like $50 per paycheck or something. So it just becomes they're trying to get you in that mold of regular investing and this whole dollar cost averaging. The strategy with that is you put in the same dollar amount each month, and when the market's down, you buy more shares, and when the market's up, you buy fewer shares. And theoretically, this dollar cost averaging mitigates the whole timing of the market. So you'll hear that term quite a bit, dollar cost averaging. Let's look at what they've got. So Fidelity is another company they're talking about. Barron's is a publication that I've used before, but it's not it was typically a weekly, monthly type paper, and it came out with some longer range forecast on mutual funds. But Morningstar is the company that gets involved with rating mutual funds. So if you're looking at a mutual fund, you'll want to see what their Morningstar Morningstar is a third party who rates mutual funds. If they don't mention that, then they're probably not very highly rated by Morningstar, so they probably don't want to talk about it. So a Morningstar rating that's above average is something you certainly want to look for. Quotations, again, we'll be looking at charts, so we're not going to spend a whole lot of time on this. This is how they'd look in a newspaper. And it's just the same as a stock, you know. They'll just use slightly different terms. They'll say NAV, net asset value, for the price rather than the stock price. But it's just an intricacy of mutual funds. Same information. The Mutual Fund Education Association, industry sponsored, pretty good information, but the websites themselves, don't just look at one, look at them all and kind of see which one's kind of the best fit for you. Most of their websites are pretty slick, not too many real clunky ones out there. Diversification amongst mutual funds. And again, look at the underlying assets. They'll be, when you look at the individual mutual fund, you can, if you wanted to, you could probably see all the assets they hold. But certainly they'll have a thing featuring their top 10 assets. International concerns, always there. Investing internationally does have a bit more risk, but the rewards can be there as well. Pardon me. So anytime you go overseas, you're going to have to deal with the currency fluctuations. But, U.S. companies that sell stuff overseas are also affected by that. Anyway, the dollar is super strong right now, which sounds like a great thing until you want foreign governments, foreign consumers to buy U.S. products and they can't afford it. I was in Europe a few weeks ago and it was cheap. But for a European tourist to come to the States right now, it would be quite a bit more expensive for them. Canadians know that as well. Hedge funds, you hear a lot about hedge funds. They use typically more complex trading type things. They'll do more leveraging. You get into SPACs, specialty purpose companies. You get into all types of things. Again, that gets more into speculation, but typically wealthy folks or institutions. Bernie Madoff, yeah, he was a dirtball, but there'll be more. He wasn't that special, wasn't that unique. He ran a Ponzi scheme, which was named after Ponzi, the guy, the crook who invented it. And what you do in a situation like that is, he's able to give these people these huge returns. But what he was doing was he was getting new investors. The new investors would give him money. He would give that money directly to the old investors and told them that it wasn't just new money to come into the fund. No, he'd tell them that it was money earnings from his brilliant investing. And as long as you had a steady stream of new investors coming in and you could give their money directly away to the older people, then nobody questioned it. It's only when there's, somebody gets a hint of scandal and the new investors cut off, and now all of a sudden the whole thing falls apart because there is no new money and there is no true investment money, and any money that was left, I think it was his son as well. Anyway, they all scam off and they're just dirtballs. So it's a con game. But these people were getting, somewhere above 20% interest on their money, and nobody else was getting that. They just thought this guy was phenomenal, and they didn't look too deeply because they trusted him, or were just greedy, and they kind of should have known. Investors should have been suspicious, which is kind of an understatement. So for the homework, we're going to do a couple things here. So this one that I talked to you before. You could almost do this in your head, you know. I used 1,000 or 10%, but anyway, 28% tax bracket. The way you figure this out is 28%. If you're in a 28% tax bracket, that means you get to keep 72% of any taxable interest, right? So you multiply 0.72 times 10.2, and it comes up to some number that's either a little more or a little less than 7.9. And depending on what side it hits, that's where you decide what you need to do. So it's not that hard when somebody says, "Oh, I definitely want the municipal bond because it's tax free." I always would take that. Well, it's not that easy. You need to do a little bit of math, not hard math, but just multiply it out, see what tax rate you're in, your upper limit of your tax bracket, and multiply that across and figure out what is best for you. Here, lady, yeah, we've done this before. I think we didn't have one of these on the test. Not that hard. There is a dividend involved here, so that changes the thing a little bit. And Knucklehead paid a commission, so that's not good. That would come out of your profits. But the dividend would go right back in, $50 per share. Depends how many years you held it. I guess we're assuming a year here. Anyway, you'd have to put that information, make that assumption. Interest rate falls, the overall economy decrease. What will happen to the market value of a corporate bond with a fixed income? So, if rates go down, prevailing rates go down, and you're holding an older bond with a higher rate, yeah, your bond would be worth a bit more money. That's nice. 20 years ago, you began investing $250 a month. This simple math. So, not a whole lot there. The podcast. So, the podcast, again, it's getting to be an older podcast. We'll make sure it's still out there. But it's a pretty good concept. It's not that I'm just lazy and haven't changed it. It's actually fairly valuable. And then reminding you again the term project. So a couple people have sent me term projects. Some are finished products ready to go. Some, will need just a little bit of work, but everybody seems to be in the right direction. It's like whatever the hardest part of a 1,000-mile journey is that first step. Just do it. Not that big a deal. Let's look at a few things here. First, I want to make sure the podcast is out there. So, Planet Money, 2016. Yeah, this is getting a little old, but it's good. That's Warren Buffett. In 2006, he made the bet, and it's kind of interesting. So, you can find that. Let's look at some mutual funds. So let's look at T. Rowe Price real quick. So again, slick site, here's some of their funds. View all mutual funds. Morningstar rated funds. Now Morningstar, unfortunately, is actually getting into the mutual fund business where they have some of their own funds, which I think kind of destroys a little bit of their credibility. But anyway, that's their thing. Stock funds, target date funds. These would be the ones where they try to change around the mix of the stocks they have under that fund to marry up with the date of your retirement, asset allocation funds. Anyway, all kinds of different funds. Let's look at all of them. And you saw ETFs over there as well, I guess. So here's a Morningstar rating. And you can see how things are, balanced fund. Well, balanced compared to, they're sort of subjective terms. Blue chip, remember I said blue chips are big companies. Now there's not a company, that I guess you could find a few, but anyway, it's a appraisal of somebody's opinion. China Equity Fund. I don't know that we'd be able to find a Vietnam fund like I was talking about, but you might. Let me just see. Whoops. Once again, if I could spell. Nope, doesn't like that. But I guarantee you there's going to be some sort of Pacific Rim something. Yeah, Pacific, Asia, Japan, Asia Opportunities Fund. It would be all these different type funds. But you have to, do a little bit of work here when you're selecting the fund. Typically, if you're going to work for a company and it's going to be, some sort of matching situation, they will have a selection of funds. They may not have thousands, because this would go on forever and ever. Tons of stuff. There are lots and lots of funds. ETFs, they get their own separate category. Target funds. So retirement of whatever date you thought that was going to be. You may end up continuing to work. Let me look at something else too. See if we'll just pick one of these funds and dig down a little deeper in it. 4 and 5 star funds. Oof. I don't know if you saw that, but there was a little Facebook thing in there. Facebook stock is not doing super well right now. Okay, so a little bit of a brief prospectus. Here's the fund manager. He's been there since 2016. How's he doing? About the same as everybody else. But in the longer term, if you got in last year, you're getting clobbered. But in the longer haul, that's not bad. 10 years, damn near 15%. That's fine. But yeah, he's exposed to a lot of things. He stayed in the market. View the prospectus. So this is going to be not as glossy, not as user friendly. But anyway, a lot of technical data, but it'll tell what they're going to do. Principal risk. It's like I say, an end user license agreement. And these people, since it's publicly traded, people go to jail if they violate, if they find to be acting outside of the rules they've set down for themselves. So I want to look at some of the holdings if I can find that. Lots of technical details. A lot of due diligence required. So starting out perhaps with a appraisal by a magazine or a some sort of online source or Morningstar rating might at least get you narrowed down, and then you would do maybe some sort of comparison. But what you'd want to make sure is that you're comparing to all of the different options and not just ones that were held by a specific company. Domestic stock, 88%. So some foreign investments, some cash, convertibles, a lot of technical stuff. They try to, give you an idea of all the risks involved. Portfolio. So here's some of the companies. Top 10 holdings. So Apple, Visa, Alphabet, which is Google. So this is where I'm saying when you think you've got this diversity, and then you look at your different mutual funds, you compare them to each other, and you see they're all full of Apple, which Apple, Google tend to be pretty high on most of these people. They've got a little bit of real estate, so this is a pretty wide fund. So anyway, you get an idea, and like I say, you can go to Vanguard. Vanguard's the guy they had the bet with, and huge company for this case for personal investors. And again, another glossy site. Great stuff behind the paywall. Better Morningstar ratings. More insight. You know, they're not going to give it all away for free. They're going to want you to, become one of their customers. And maybe you already are. So just for giggles here, I want to see how specific we can get. Yep. So here's the Van Eck Vietnam. Here's the MCI. So you can, you know how, I was in Malta a few weeks ago. Pretty neat place. Banco de España. I guess they don't warrant their own mutual fund. But I can't find one that's, based on countries in the Mediterranean. Malta may not have the manufacturing base as opposed to Vietnam, but mutual funds, you can find what you're looking for. Socially responsible, and everybody has got whatever. Schwab, every company's going to have one. You can even go by sector. ESG, environmentally. What is it? Environmental sustainment guidance? Social governance. Sorry, ESG scores. Maybe going out of favor. We'll see what happens. But BlackRock, huge in the whole ESG process. And here, before he can go forward, they want some information. Anyway, interesting stuff. I think you'll enjoy that podcast. I think it's kind of interesting to kind of figure out how those things work. And they do some explanations, and we'll see what comes next. Investing right now it's going to be a hugely dynamic environment. But mutual funds will still be one of the best investments out there, because especially in times of uncertainty, if you're going to be in the stock market rather than being individual stocks, mutual funds would be probably the way to go. And real estate again will be good as well, but real estate right now is mortgage rates are hitting about 7%. Real estate agents are basically unemployed. It's a tough time for everybody, so we'll see what happens. Anyway, till next week.